You can spend a decade trading markets without ever understanding why the same chart can tell two different stories. Yet most never stop long enough to consider the answer. They get lost in the frenzy of candles flashing on a short-term chart, hypnotized by every wiggle and spike, convinced that opportunity lives only in movement. But the market is bigger than any one time frame. The real capital sits beneath the surface, where the story begins long before the hour bar is drawn. I learned early that a single trade is not the market. It is just a footstep on a long road. The weekly chart, silent and steady, lays the roadbed. The hourly chart, frantic and noisy, is how your feet strike that road. When the two line up, the journey is smooth. When they oppose, every step feels uncertain, and even the right idea becomes punishment. Most traders never ask which side of the current is flowing strongest. They trade the hourly bar as though it were the entire river, and then they complain when the current pulls them under. But the river has depth. The weekly chart is where the tide is turning. It is where money is slowly pushing direction over days and weeks. The hourly chart only reflects that pressure in smaller bursts. Bringing the two together isn't optional if you intend to last in this business. It is survival. There were days when I'd stare at the ticker tape convinced I saw an opening. The numbers flickered faster than thought, and conviction came hard and sudden. I'd buy into strength or sell into weakness, only to find myself fighting a force 10 times greater than what I had imagined. That force was the major trend. The longer time frame was against me. A speculator can fight many battles and win a few by chance, but he cannot fight the tide. The market always wins those contests. So I learned to step back far enough to see the real direction. A weekly trend drifting higher is like a ship pointed north. When the wind is with you, even the smallest sail will move forward. But an hourly pullback against that trend is only a gust of headwind, temporary and weak. If you trade that hourly gust as though it were a storm, you place your capital against the very force that carries the larger move. That is how accounts bleed slowly, one stubborn trade at a time. The hourly chart is not useless, far from it. It is the scalpel when the weekly chart is the map, but a scalpel without direction is a weapon turned against its owner. The job of the weekly is to answer the first question every trader should ask, long or short, up or down, attack or defend. The hourly chart answers the execution question, where do I enter, where do I place risk, and when do I step aside? Most traders flip that order. They start with the hourly and ignore the weekly, because the weekly demands patience and discipline, qualities few can muster consistently. Impulse prefers the short term. Ego prefers to play hero, where the immediate movement offers a chance to be right now rather than right overall. But this business does not pay for being right now. It pays for being right with size, aligned with the strongest force. If you have ever bought a dip on the hourly only to watch it continue to fall for 3 days straight, you know what I mean. You felt early, then wrong, then foolish. You swore you would wait for confirmation next time. You promised yourself you'd check the bigger trend. Then the temptation returned the next day, and you repeated the mistake. Markets are merciless teachers, but they send the same lesson until you finally accept it. The skill you must build is anticipation grounded in context. The weekly chart gives direction, momentum, and significance. It shows when the wind has shifted, when markets are no longer rewarding the same behavior, when distribution begins replacing accumulation. It reveals when the crowds are exhausted and a trend may be ready to reverse. You won't catch the exact turning point. No one does. But you can catch the confirmation that matters, and that's enough to build a fortune if you stay patient. Once the weekly makes its verdict, then and only then does the hourly chart become your tool. When both time frames point the same way, your job becomes easier. You're no longer betting against the house. You're moving with the professional money, with funds so large they take weeks to build a position. They don't buy because of one hourly candle. They accumulate over time. They test levels. They shake out the weak, and when the move finally shows itself, the public thinks it began that day. They are late by weeks. Your goal is to read the quiet tells long before the noise begins. When the weekly begins to push, you watch the hourly for the doorway. That doorway is often simple. A higher low in an uptrend, a lower high in a downtrend, a surge out of consolidation following a weekly direction. These are not mysteries. They repeat endlessly, because human nature repeats endlessly. Fear and greed do not expire. But there is a trap here, too. When learning multi-time frame alignment, traders often twist the rules to justify what they already want to do. They look at an hourly setup they like, and then hunt through the weekly chart for a reason to validate it. That is not discipline. That is rationalization dressed as strategy. The weekly first, the hourly second, not the reverse. Patience here is your greatest ally. If the weekly is unclear, stand aside. If the weekly is flat, wait for it to break. Nothing destroys traders faster than inventing opportunity when none exists. The market owes you nothing. Opportunity does not arrive on your schedule. You must learn to sit idle without guilt when the alignment is not there. That stillness is part of the work. Missed trades are cheap. Bad trades are expensive. The weekly chart keeps you out of most bad trades, and the hourly lets you capitalize on the good ones with precision. The trader who lives on a single time frame lives blind, either to the macro force or to the tactical opening. Only when both are visible does the market unfold its true edge. I have seen men lose fortunes because they confused motion for direction. They mistook noise for signal. They mistook being active for being productive. The only activity that matters is the one aligned with the prevailing tide. When the weekly moves one way and the hourly another, you are stepping into a battle between currents. The weekly wins every time. This is where traders break. They chase what worked yesterday without recognizing that yesterday belonged to the lower time frame. They cling to hourly entries long after the weekly tide has turned. They widen stops to accommodate their stubbornness, telling themselves the market will come back. Sometimes it does. That is the worst outcome of all, because it teaches them the wrong lesson. It feeds the illusion that discipline is optional. You must train yourself to think differently, to enter only when time compresses and both charts are speaking the same truth. A weekly trend rising with an hourly pullback into support is where risk is smallest and reward is largest. That is where confidence comes not from hope but from structure. The stop is clear. The direction is defined. Your mind is calm. Most traders do not realize that alignment removes much of the fear that eats them alive. When you follow only a single chart, every movement feels personal. Every candle feels like an attack or a reward. You cling to the smallest fluctuation because you have no larger story to stabilize your thinking. You behave like a man lost in a forest who only sees the next tree. But when you step back and study the weekly first, you understand the shape of the land itself. The trees become familiar. You see the path. What once terrified you becomes nothing more than contour. The markets are full of deception, but the greatest deception is the one we create for ourselves. We tell stories about why a move should continue or reverse. We justify our hopes with biased interpretations. But charts are not for storytelling. They are instruments for measurement. The weekly measures the tide. The hourly measures the waves. Neither cares what you believe. Both will tell you the truth if you are willing to listen without ego. There was a time when I believed that I had outsmarted the market. I imagined that with enough study and attention, I could master every turn. I sat for hours watching every tick, convinced the secret lived in the smallest movement. The market tolerated my arrogance for a while, allowed a few lucky wins, and then did what it always does. It taught humility with losses. I bled until I learned that the smallest movement means nothing if the broader tide is turning against you. A man who builds a castle in front of a rising tide will see it swallowed whole. The lesson is simple. Build where the tide is receding or rising in your favor. Even today, traders buckle when a position goes against them by a few ticks. They feel panic not because the trade is bad, but because their conviction has no foundation. They never checked the weekly. They never confirmed the direction. They entered because they wanted action, not alignment. When you align the weekly with the hourly, small adversity does not shake you. You already know your position is supported by the larger force. You endure the small movements because you can see beyond the moment. Trading is not a profession for those who crave constant excitement. It rewards the ones who can sit for days waiting for two charts to speak the same language. It rewards the people who find confidence not in prediction but in preparation. The market does not pay the impatient. It pays those who survive long enough for the tide to carry them. When I speak of aligning the two time frames, I do not mean simply matching colors or directions. I mean finding harmony and structure. If the weekly is trending higher and making new swing highs while defending swing lows, the market is telegraphing accumulation. Buyers are in control. In that environment, the hourly chart becomes your entry mechanism. You want pullbacks into support zones, not breakouts into exhaustion. You want to buy when the market is handing you opportunity, not when it is seducing the herd with obvious strength. In a downtrend, the process reverses. The weekly turns lower, each rally smaller than the last, each push up met with heavier selling. That is when the hourly becomes your scout. You wait for weak rallies, for cracks in momentum, for breakdowns through support levels the public swears will hold. You do not gamble. You exploit. You allow the broader force to show its hand. And then you use the hourly to strike with precision. There is another layer to this that few discuss. Multi-time frame alignment trains emotional discipline. When the weekly is trending and you follow it correctly, you stop taking trades that have no business being taken. You remove the noise from your decision-making. You begin to realize how few trades you need. You no longer chase every setup because most are irrelevant to the tide. The fewer you take, the fewer mistakes you make, and fewer mistakes are worth more than any new strategy. The hourly chart is full of false signals. It turns constantly because it is closer to the friction of the market. It reacts to temporary pushes by traders who will not exist tomorrow. The weekly chart filters that noise. When both agree, the rate of false signals drops to nearly nothing. You begin to spot patterns that others dismiss. You see strength building under the surface long before it breaks into the open. You catch weakness while the public still imagines victory. One of the gravest dangers in trading is believing the market owes you clarity. It doesn't. Some weeks you will stare at a weekly chart that refuses to reveal direction. It will coil, range, compress. You will see arguments for both sides. In those moments, novices insist on trading anyway. Professionals wait. The market is preparing energy, not handing out opportunity. When the break comes, it will be violent and swift, and those who were patient will feast while those who traded inside the chop bleed from 1,000 cuts. You must develop the capacity to do nothing. The world teaches you that productivity means constant action. The market teaches the opposite. The greatest profits come from alignment, not activity. A trader who takes one aligned trade a week will outperform a trader chasing 10 meaningless trades a day. This is not theory. This is arithmetic of expectancy. The alignment between hourly and weekly time frames also grants you consistency that is impossible otherwise. Consistency is born from structure, not luck. When you build a process where every trade begins with a question, what is the weekly trend and how can I participate through the hourly, you strip away randomness. You build a method that can be repeated whether the market is bullish, bearish, or drifting sideways. You stop improvising. Improvisation has ruined more accounts than bad analysis. A trader aligned with the weekly trend can survive poor execution. A trader fighting the weekly trend cannot survive flawless execution. That is how powerful the long-term tide is. If you have ever wondered why you do everything right and still lose money, look at the weekly. You may simply be rowing against a current too strong to overcome. There will come a time in every trader's journey when aligning these time frames becomes instinctive. You will not need reminders. You will not need to force yourself to check the higher time frame. You will feel uneasy trading without it, the same way a sailor feels uneasy leaving harbor without reading the wind. That instinct is earned the hard way, through pain and study and reflection. But once it is yours, you will see markets differently from most. You will see structure where others see chaos, and opportunity where others see confusion. This business is not about precision. It is about positioning. Aligning weekly and hourly time frames positions you with the flow of capital. It puts you where money is moving, not where it might move if fortune smiles. That is how professionals operate. They do not pray. They prepare. The final truth is simple. The market is not random. It is human nature on display. Humans chase power, safety, momentum, comfort. The weekly chart reflects the collective, slow decision-making of institutions and crowds. The hourly reflects their reactions and their emotions. When the two agree, the human condition is most predictable. That is your edge. It always has been. Once you accept this, trading stops feeling like combat. It becomes execution. The market will still surprise you, but surprises become manageable. You will take losses, but they will not devastate you. You will capture trends not by luck, but because you recognize the direction long before the crowd. This is how traders survive decades in the market instead of months. They respect the tide. They use their smaller tools only when aligned with their larger compass. The hourly chart sharpens your entry, but the weekly chart defines your mission. And when both tell you the same thing, you listen, execute, and then let the market do what it always does: reward patience and punish ego.